Hi friends, very recently I created this video where I spoke about the mutual fund strategy in 2025 and I had covered two types of investors. Number one is conservative and number two is balanced investors. On that video, so many of you dropped comments saying that Rahul, can you also cover aggressive investors in part 2? So I'm shooting this video on your demand to bring you what is the mutual fund strategy, sensible mutual fund strategy for aggressive investors. Now, first point is that who are aggressive investors? So aggressive investors are those investors who can withstand huge volatility in their mutual fund portfolio. Even if their mutual fund portfolio is down by 20%, 25%, 30% for whatever market disruption reasons, they're still not panicking because they are looking for long-term wealth creation and they are happy to withstand that volatility. They are not going to have sleepless nights. So for such investors, I'm creating this video and I'm going to bring you lot of learnings and insight. Please do not subscribe to my channel. Just watch this video for the next 5 minutes and I'm pretty sure that you're going to love this content because you're going to naturally learn a lot of things in this video. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. With that, let's get this video cracking. Before I start aggressive investors mutual fund strategy, let me quickly in 30 seconds do a recap of conservative and balanced. So for conservative investors, we said that fixed deposit and debt mutual funds make a lot of sense. For balanced investors, we spoke about multi-cap, flexi-cap and Nifty 50 index. And I gave you a lot of insights about misconceptions in all these three areas. Now coming to aggressive investors, number one question is that should we look at mid-cap mutual funds and small-cap mutual funds and what is likely to happen with mid-cap and small-cap mutual funds in 2025. So in my view, mid-cap space is not looking very attractive in 2025. Let me now present you some data. Have a look at my screen. You will see that after COVID, if I remove this drawdown because of COVID, if you see since September 20, almost 4 years now, and we have seen 200% rally in mid-cap space. This is Nifty Midcap 150 index. Now what this rally has done is the valuations have gone out of the roof. For example, the pink line you see here is the PE ratio of the Midcap 150 stock. And what you will note here is the sudden jump in the PE ratio. And you see right now the PE ratio is at almost around 40-42 level. In my view, mid-caps are running at a very high valuations and the upside now may be limited. Again, I'm not saying that they are not going to give you returns. They may give you returns, but for the risk that you are willing to take as an aggressive investor, does the risk reward ratio justify? In my view, it doesn't. Of course, it doesn't mean that you stop doing your ongoing SIPs in mid-cap. Please make sure you continue with your SIPs. The whole purpose of SIP is to continue and not try to time the market cycles. It's very important you continue with your SIPs. The reason I'm speaking about not to look at mid-cap is from a fresh investments perspective. Now natural question comes, Rahul, what about the small cap space? So have a look at my screen. You will see that small cap index after COVID, so almost from September 20, if you see, has gone up by 215% almost in the last 4 years of time. And now if I speak about the valuations, have a look at the pink line here. You will again see that the PE ratio has gone very high, almost now touching 30 PE. In my view, that is a high PE, albeit lower than the mid cap, but still I feel that mid cap and small cap in 2025 either are likely to see consolidation or some muted returns. In my view, that is not for aggressive investors in 2025. Yes, if you're looking for 10 years down the line, you can still continue to do your SIPs, not a problem there. Now let me present to you what will make a lot of sense for aggressive investors for 2025. So the first good option in my view for aggressive investors is an index called Nifty Small Cap 250 Quality 50. Allow me 2 to 3 minutes of commentary time. You are going to learn a lot. Have a look at this index's return. First of all, if you see, as of December 2024, on a 5-year basis, this index has returned 34% yearly returns. Compare this with normal Nifty Small Cap 250 index. If I show you the data, you will note that in the last 5 years, here this index has given around 30% yearly returns. So clearly Nifty Small Cap 250 Quality 50 index has beaten the normal Nifty Small Cap 250 space by easily 4%. If I now speak about the longer term, since inception, 10 years, 15 years, whenever this index was created, if you look at that data, it has given 20.71% returns versus Small Cap 250 space that has given 17% return. So clearly from a long term perspective, this index has done better than the small cap 250 index. But comes even more important point, that the valuations of this index. So if I show you the valuations, the PE ratio as of December 2024, you will note the PE ratio is around 26.41. But if you see the small cap 250 space, that is running at a PE ratio of 34, almost 8 more PEs is what we are seeing in small cap space. Now that's where I really want you to understand this particular index, because it is not highly overvalued as compared to small cap 250 index, but at the same time it only concentrates on 50 quality small cap stocks out of the 250 stocks. Now allow me 60 seconds of time to explain you what do I mean by that. Have a look at this slide here and you will know that we have total 250 stocks in the small cap space, and typically if you go and invest in any mutual fund, the mutual fund manager will try to pick up 50 or 60 stocks out of 250 based on that fund manager's conviction, right? Here in this index, what is happening is it is trying to bring quality 50 stocks based on set criteria. What are those set criteria? First criteria is to not pick up bad quality stocks. What do I mean by bad quality? So for example, any small cap stock that is constantly hitting circuit breakers, for example, lower circuit, upper circuit, any small cap stocks that have got high pledged promoters holding, where the promoters have pledged their stakes, never a good sign for small cap stocks. It is going to not consider those ones. For example, if the valuations are very high, it is not going to consider. That's why we see the valuations were less. Right? Also volatility, when it is very high, it is not going to consider. So it is going to apply a number of exclusion criteria to make sure it is getting rid of bad quality small cap stocks. Then the second thing it looks at is, out of the remaining ones, it will look at the stocks that are quality 50 stocks. And how will the index determine that? It is going to look at some very important ratios. For example, return on equity, where if the debt to equity ratio is low, it is better. And then earnings variability, where you see stable earnings. And that is where, in my view, quality 50 stocks have managed to outperform the small cap 250 space. Ultimately, it is looking at certain set parameters and trying to drive only the quality 50 stocks. Now, before this video, if you did not even hear about this particular index, I request you to like this video. Let me know in the comments a simple thank you. It motivates me to bring such content for you at zero cost. With that, now the natural question is, Rahul, if we were to invest in this particular index, what are our good options? Unfortunately, I could only find, at the time of recording this video, I could only find one index mutual fund, that is by DSP. It is not a recommendation. It is not a promotion. I am genuinely trying to bring you insights that are not available for you. Either you don't have time or expertise, whichever is the case. Therefore, please do not take that as a recommendation or a promotion or investments. I want you to understand things in a practical data-backed perspective. So DSP Nifty Small Cap 250 Quality 50 Index Fund is the only one I could find. I don't know when you're watching this video, there might be another fund houses that might have launched this particular mutual fund. Please go and check it out. But let me now quickly give you 30 seconds commentary about this particular index fund. First of all, it is a passive index fund. Here it is going to track the Nifty Small Cap 250 Quality 50 Index. The fund manager is not going to try and pick the stocks based on their convictions. It is simply going to follow the index. That is point number one. Point number two is that always go for direct growth fund, because the expense ratio is going to be really low in that case. So for example, the expense ratio is only 0.3%. So just imagine you are only paying 0.3% for you to pick quality 50 stocks based on certain criteria which are predetermined. I mean, what else could you expect when it comes to the mutual funds? So I think that's a very, very reasonable expense ratio. The AUM is not very large, only 172 crores. Maybe people don't even know about these index funds that are there. Therefore, the AUM might be low. If you look at the exit load, there is no exit load here, but please do not get into these mutual funds or index funds if you're only looking to invest for 1 year or 2 years. Please make sure you have a long-term horizon, because even if you're an aggressive investor, all of a sudden mutual funds might come down by 20%, 10%, 30% because the market conditions could totally change in a jiffy. For example, here, since December, if you see, it has been fallen consistently because we have seen a broader market correction in the recent times. Again, I don't know when you're watching this video, but please make sure you're not getting into any of these mutual funds. If you have at least more than 3 years of time horizon is when you should consider these mutual funds. So in my view, small cap 250 quality 50 index is placed much better than the small cap index. And if you like this analysis, hit the like button. Also, you can consider joining my YouTube member community. On a daily basis, I am posting a lot of insights about stocks, mutual funds, ETFs, various assets that will make you an informed long-term investor. The feedback of this community has been excellent. Simply go to my channel, press on join button and be my guest. Also, you'll find the link in the description or in the pinned comments. With that, let me move to my second option. The second mutual fund for aggressive investors in my view could be Nifty Microcap 250 index. Have a look at my screen. Let me run you through some important details about this particular index. A lot of misconception that people don't even understand. First point is that if you look at the last 5 years returns, this index has delivered 43% annual returns in the last 5 years. Since inception, if you see, almost 19% yearly returns that this particular index has generated. These returns are much higher than the mid cap and small cap space if you look at the last 5 years or 10 years. More importantly, if you look at the valuations of micro cap, as of December 2024, the PE ratio is 30, which is much better than the mid cap. Mid cap we saw like 42, 43. Again, these things change. Now, if you also look at the allocation by sector, you will see that it is a much more diversified index. Capital goods 18%, which is the top sector here, followed by healthcare 11%, financial services 9%, so on and so forth. I will now tell you what the micro cap company actually means. So if you look at the top 500 companies, if you remove large cap, mid cap, small cap, after these 500, if you take the next 250 companies, these are called micro cap companies. They are not suitable for balanced investors or conservative investors. They are only suitable for aggressive investors. For example, if I now show you some data, you will note, you see the brown line here. You will note that when the market corrects, this index corrects hugely. So for example, back in 2012 or 13, this index saw a drawdown of almost 60%. Of course, that was a one-off situation. Back in 2008 and 9, it went down by almost 70 to 80%. So we are talking about huge risk in this particular index here. But of course, the returns are like that over a longer period of time. These events matter less as long as you are comfortable with volatility. For example, if I now speak about the SIP returns, if you see the last 10 years, returns have been very good. 27% yearly returns is what you're getting if you do SIP. Last 5 years have been even better because we have been sort of in a bull run. 46% returns is what we have seen. But as I said, these are high risk, high reward sort of investing style. Only enter into these sort of mutual funds if you are not looking for 1 year or 2 years, you're looking at 5 years, 8 years, and you are okay to withstand the volatility, because all of a sudden when market falls, people say, oh, this was a bad mutual fund. No, it was not a bad mutual fund. You just did not understand that market is going through a cycle and you have to remain invested. In mutual funds, the one skill that people are not able to master is to remain invested when the markets are falling. And that's what if you practice over a longer period of time, you're likely to see good returns. The data is telling us this. In the past, future, of course, is unpredictable. Mutual funds are subject to market risks. Things may change, but hopefully this has given you a lot of insights about this microcap index. I could only find one Motilal Oswal Nifty Microcap 250 index. Again, not a recommendation here, not a promotion here. Please go and at the time of watching the video, check out if there are any other mutual fund offerings there in this particular space. Compare the expense ratio, compare the AUM, look at whatever factors you want to before you go down this route. If you like this analysis, hit the like button while I move to my third mutual fund. The third mutual fund or the index fund that makes a lot of sense in my view right now is Nifty Next 50. Generally, I do not like Nifty Next 50 for various reasons, but right now the valuations wise, it looks very, very attractive. If you remember, for conservative investors, my view was that Nifty 50 is better placed. But when it comes to aggressive investors, you could look to take slightly more risk, and in the large cap space, you can look at Nifty Next 50 right now because of the valuation. So for example, have a look at my screen. You will see the pink line is the PE ratio or the valuation for Nifty Next 50 in the last 4 to 5 years. And you will note that this particular index used to trade at around 40-42 PE back in May 2021. Since then, if you see right now, the PE ratio is at almost 23, which in my view is placed in a very, very good way versus even the small cap and mid cap, which are highly overvalued. Now, when I speak about the Nifty Next 50, if you look at the last 5 years returns, 20% yearly returns, not too bad from a large cap perspective, because you're trying to balance risk versus rewards here. If I speak about the sector allocation here, it is well diversified as well. Financial services 23%, consumer services 13%, power 9%, and so on and so forth. In terms of the companies, you can see as of December 2024, companies like Zomato, Geo Finance, Interglobe, Varun Beverages, these were part of that particular index. Of course, I don't know when you're watching this video, Some of them might have gone into the Nifty 50 itself. That's why Nifty Next 50 present you that opportunity, because these are the growing companies. These have the chances to become the Nifty 50 stock in the next 2 years, 3 years, 5 years, whatever the time period. But right now, the valuations wise, as of December 2024, as I said, the valuation was 24.9. It is at a much better valuation than what it was 3 years, 4 years back. So if you're looking for a 3 years or 4 years of view, the growth is likely to be there in the large cap space. This is a large cap space. So Nifty Next 50, in my view, looks very, very comfortable. When it comes to which index funds you can consider in this space, I've done some analysis here. So for example, last 3 years average annual rolling return, I've taken, and you will see the top 5 mutual funds here: Axis, Navi, HDFC, SBI, Kotak, etc. have delivered far better average rolling returns in the last 3 years. Again, past returns do not guarantee us the future returns, but at least this is an indication here. If you look at the Sharpe ratio and the Sortino ratio, which are the risk adjusted returns, almost very similar picture, 1.2 point here and there, not much difference. But if you look at the tracking error, I would say SBI here is showing the lowest tracking error, albeit the returns are not very high, but the tracking error is low. What does this mean? That this mutual fund or this index fund is able to track the index very, very closely. And if you want to take your bets on the index, then this has delivered the better tracking error as compared to many others. Alpha in the last 1 year has been better, 0.99, almost 1, as compared to other mutual funds. This is a better alpha in the last 1 year. But it's up to you, which one do you want to go ahead with in terms of the Nifty Next 50 if you consider large cap space as well into your portfolio allocation. So in this video for aggressive investors, I've gone through 3 mutual funds and I've described risk versus rewards. I've given you a lot of insights, and hopefully that have made you a better investor. You've gained insights. And if you have liked this video, let me know in the comments. A simple thank you. You can also consider joining my YouTube member community, because I speak about various assets almost on a daily basis. You're going to learn investing practically over a longer period of time. With that, I hope you enjoyed this video. I'll see you in my next video. Until then, keep rocking.